we are going to be speaking with Tom Lee. He is, of course, the co-founder and head of research at Fundstrat Global Advisors and FS Insight. Tom, welcome to the show.
Thank you very much.
So I know you're sometimes described as an Uber bull. Is that a fair characterization of how you feel about markets?
I think that label is not reflective of how I feel about markets. I think that label is generally used by perma bears who've been perma wrong, and it's a cheap shot taken.
Okay, but I get that it sounds like a cheap shot, but on the other hand, Uber bulls or perma bulls historically have like 100 years of lines going up and to the right on their side. So my view when I hear someone being described as a perma bull is, oh, this is someone who, except for like 5 minutes here and there in 2020 and 2009, is perma correct.
Yeah, I'd say so. I think people don't live in those longer time frames. In the day-to-day, people live as if this is a street battle, and the label Uber bull is like someone, well, you know what? He might lead us out, but I don't trust him because we're in a street fight. And so it's generally, I find people saying it more as a cheap shot.
No, the people who say it are all really obnoxious. That I agree.
I didn't mean to be obnoxious. Wait, did you just call me obnoxious?
No, when you said it, you were characterizing other people.
Yes.
Well, I feel like we should give people
no offense.
Okay, excellent. I feel like we should give people the opportunity to describe their own work. But why don't we talk about something concrete, which is at the beginning of this month, Tom, you at Fundstrat put on an S&P 500 target of 5,500. We're at about 5,475 or something like that right now. So just in that short time frame, you called it correctly. What did you see?
This is actually a textbook rally. At the start of this month, we alerted our clients that since 1927, when you look at the start of June, but markets were up in the first quarter, but then had a drawdown in April, which is what we had.
Yeah.
That happened 11 times. 11 of 11 times, June was a positive month. So May is essentially a recovery month, and then June is the month where markets go back to risk on. The median gain since 1927 is 3.9%, which calculated to 5,500.
There you go. Simple math. Investing made easy. But zooming out, you're at Fundstrat. For years prior to that, you were at JP Morgan. I was a big fan of your work then, correctly calling for much higher stock prices through much of the 2010s when there were still a lot of people calling for double dips and the sort of rise of a pretty large bearish contingent. How do you work? What do you do? Because there are all different approaches that people have towards, making educated guesses as to where the stock market could go. How would you describe your approach?
Well, fundamental to our process is evidence-based research. Okay. So, at the core, we really try to frame where history could explain where we are today.
Okay.
We rely on a lot of cross-market signal. So to us, the bond market is always smarter than the stock market. That's why they say equities are the land of C students. And the third is, of course, monetary policy is really the driver, so you can't fight the Fed. And then I think the fourth is that thematic approaches surpass cyclical approaches.
What does that mean?
Well, part of our work relies on what we call thematic drivers. One is millennials.
Okay.
So that's since 2018, we've talked about how millennials, which is the largest generation, are reshaping the economy, which they are, mainly through fintech and changes in preference. But of course, now coming is a big generational wealth transfer of as much as $80 trillion. The second, of course, is that there is a huge global labor shortage, which has started in 2015 and won't be resolved till 2035. And the two previous instances of global labor shortage resulted in a parabolic move in technology stocks, which has been part of our thematic approach. And now we see two other things like energy security and cybersecurity are huge thematic drivers, especially because of AI. And so this grounds our work. We not only use it to judge markets, but we use it to build our Granny Shots core stock portfolio, which is a thematic portfolio, picks the strongest stocks within each theme. And that has outperformed every year since 2019.
I'm trying to think how to phrase this question, but what do the strong themes mean for the overall market? Because I think everyone would agree that stuff like AI is interesting and promising, maybe a little overhyped at this point, but you could make the argument that there is potential there. And yet, we've seen the S&P 500 as a whole go up. And there is that argument over breadth, like how much of this is purely AI and the stuff that people are getting excited about versus general optimism about the market.
Well, I mean, if I look at the stock market, I think it is playing out with all the things you just mentioned, because the groups that are affected by high and tight monetary policy have really lagged, whether it's the regional banks or industrial multiples are being suppressed. And we know that the spend and actually now some of the synergy coming from AI is driving not only the producers of AI like NVIDIA and some of the software companies, but and many of the companies that are leveraging this for revenue growth. So I think it is playing out. But overall, I think it's on balance a healthy economy because companies are generating good earnings growth and the labor market has come back into balance and consumers aren't highly levered, which is really the big deal, because to me, when consumers can't borrow more money because they've borrowed too much, that's really when the economy hits the tipping point.
When it comes to consumer balance sheets, just on this, what do you look at when you say, okay, the consumer is not high levered? I always see discussions like, oh, excess savings gone.
People look at total credit card debt.
Yeah. What do you look at?
Well, I think the gold standard is still the debt service ratio, which the Federal Reserve puts a lot of time into and employs a lot of economists to build a fair view. And the debt service ratio today is still under 10%, which, for instance, before this decade, you'd be in a sort of peak consumer borrowing at the 14 to 16% level. So consumers can, if interest rates don't move, they can borrow 40% more money. I think the excess savings is a spurious argument because I don't remember it in my 30 years people saying consumer cycles turn when their excess savings is gone. I mean, that's not really been how the business cycle works.
You mentioned 30-year career just then, and I realized I'm kind of unfamiliar with you other than at Fundstrat. Can you maybe give us a recap of what you've been doing for 3 decades?
Yes, I've essentially had the same job for my entire post-college career. I started off at Kidder Peabody in the early 90s.
One of my old bosses was at Kidder Peabody.
David Dwyer?
No, someone else.
Okay.
Anyway, sorry, keep going.
Yeah, I got into stock research at that time, and I was working at the sector I was assigned to was wireless. So the first 14 years of my career arc was as a technology analyst covering the wireless industry, which, again, for my clients, many of which I still have from those days, no, I'm not an uber bull because there were many times I had sell ratings on stocks, but it's not fun to be telling people to short a stock that they own. That's when they're very angry. And then in the 2000s, wireless was consolidating, and I wanted to find some other things to do. So I started to do some work on bankrupt stocks because many wireless stocks went bankrupt. I did a whole piece called The Chapter After Chapter 11, where I looked at over 2,000 publicly listed bankruptcies. I used our Mumbai team, or at the time we called it Mumbai team, at JP Morgan, and we went through all these filings and we found that stocks that emerge from bankruptcy do well. So we had a whole strategy around buying bankruptcy stocks. And then JP Morgan asked me at the time if I wanted to become the small cap strategist on top of wireless. So I had 2 jobs. I ranked in both categories. And then in 2007, they asked me if I wanted to become the chief equity strategist, which I've been doing ever since.
Oh, nice.
And started Fundstrat 2014. So this is our 10th year.
Oh, congratulations.
Congratulations. Okay, so given your history with the wireless companies and technology overall, I feel like I have to ask you about AI and NVIDIA and all of that. Is there any common thread or any valid comparison between the AI boom that's happening right now and, say, the internet bubble of the late 1990s and early 2000s?
There are a lot of parallels. When I started doing wireless, there were 34 million cell phones. Today, there's 7 billion. So it's a hyper-growth industry that grew almost in parallel with internet, because without mobile, you wouldn't really have the internet that we have today. In the early stages of that growth. So when you look at penetration, Wall Street always underestimates the importance of the technology. And part of it has to do with it's a generational lens. Every new technology is adopted by a young cohort, people in their 20s, teens, or even 30s. But most people on Wall Street are in their 40s or 50s. So they're one generation removed. I remembered when our PC analyst at Kidder said, why would you have one computer per household, or even more than that, because they're $2,500. And I know when cell phones first emerged, people thought it was a yuppie toy and it was going to be only for people who make $75,000 a year. But what I learned as a wireless analyst was teenagers and young kids, especially in Europe, were using cell phones. So I used a vintage model saying that if 100% of like teenagers have a cell phone, by the time they're 60, the penetration rate should be whatever it is. That's like AI. The adoption rate for AI is staggering, but the use case is important because there's a labor shortage. So to me, I think it's very likely we're underestimating how much revenue all these companies will make. I can give you some simple math.
Yeah, please.
The global labor shortage by the end of this decade is close to 40 million worker equivalents. And that's $3 trillion of wages.
Okay.
We're turning labor cost into silicon, or into tech automation, of which we know today 80% is hardware or silicon. So does that mean whoever is supplying the chips might have a $2 trillion revenue? Probably. And right now, the largest share of that would go to a company like NVIDIA. So if NVIDIA is $100 billion in revenues now, what is, by the end of this decade, is it $800 billion, a $1 trillion revenue company? And then what should we discount that rate at? I'd say there's probably a lot of upside.
So that's sort of the argument from the fundamentals perspective. The other thing people like to do is they like to draw these dual x-axis lines where they're like, here's the chart of NVIDIA starting at some arbitrary date. Here's the start of Cisco starting at some arbitrary date. And they line up the peak so that the peak always happens to be right now. But regardless of the fact that that's, largely what knaves and scammers do, it is true that just from an overall index perspective, there is an incredible lot riding on a handful of companies right now, whether it's NVIDIA specifically, the Mag 7 more broadly, and that, in 1999, there was just an incredible weight on Cisco and Sun Microsystems and Microsoft and a couple of others. Do you see any parallels in the market environment?
Yes, there's a lot of parallels, but there are some differences. Keep in mind, Cisco sold a $100 box. NVIDIA is selling a $50,000 chip. So the moat around that is much, much greater. I also think to contextualize this, we need to look at the global economy.
Yeah.
If we're turning labor cost into silicon, then which countries are really the primary suppliers of technology? The U.S., by a country mile, is the only supplier. So the U.S. is essentially exporting technology now. And that's different because internet was more democratized. People just put up towers and laid fiber. You can't, create your own version of an NVIDIA chip. You have to buy it from NVIDIA. So I think that tech will probably be, 40, 50% of the global stock market weight.
Where are we now?
That's probably 20.
Wow.
It's probably like 18. I mean, in the U.S. it's only 40.
And when in the U.S. it's 40, globally it's 18, and you say it's going to go to 40 to 50% globally.
Yes, because you're replacing recurring labor costs with a capital investment.
Oh, interesting.
So you mentioned the net present value of tech stocks just then, and I'm curious, talk to us about rates, the higher interest rate environment, and what it means for stock valuation, because I think this is where people are either a little bit surprised or perhaps a little bit nervous, the idea that even in the higher rate environment, stocks can move upwards.
Yeah, well, again, I can cite some history and then maybe provide some context.
Please.
But since 1935, when you look at the relationship between the 10-year yield and forward PE, it is not linear. It is a dynamic relationship. And between 4 and 7%, it is positively correlated. So when interest rates go up, PE rises. Logically, it sort of makes sense because you're seeing it now. When you have higher rates, it's barriers to entry. So the existing companies make more money and companies earn money on their cash. So unlevered companies are actually, for Apple, it's like $6, $7, $8 in earnings, right? Some big number. Actually, with splits, it's lower. And between 4 and 5%, the median forward PE has been 18.5. And 48% of the time, it's actually above 20.
And so, what's S&P trading at now?
Well,
the PE?
The forward PE is probably around 18.
Okay.
But the median forward PE is 16.
What should we make of the fact that a lot of the market is not doing well? So again, for those of us who are just like the boring, put it in an index fund investors, amazing year, but there are big chunks of the market. The Dow is only up 2%, I know, or something like that. What should we read? Does it say anything that so much of the market is doing pretty, I guess, mediocre this year?
I think it speaks to a lot of things. One is the market is starved for cash. I mean, there's $6 trillion cash on the sidelines. FINRA margin debt is like 20% below where it was in October 2021. So there isn't a lot of money sloshing in the stock market. I know it's weird because we're at record highs.
Yeah.
So if there is money actively trading, it's just buying the high volume sectors, which is tech. From a rates perspective, and I kind of mentioned it before, like the groups that are hurt by tight policy have really been sucking wind. So I think if monetary policy eases or people are more convinced of it, then breadth expansion is going to be pretty fierce later this year.
What is your outlook for rates at this point? Because you mentioned the strong consumer earlier, but on the other hand, we have seen a little bit of weakening in the labor market. We have seen CPI start to soften, although there's a lot of debate over whether or not that's going to be a durable trend. But what are you seeing?
Well, I think inflation, if we looked at historically how people looked at inflation, whether it's the surveys or ISMs, inflation's under control. Because like, for instance, the ISM services manufacturing, the prices paid component is below the long-term average right now. So at 57, people think 57 means price going up. That's not true. It's averaged like 58 since inception. So actually price trends are below where they have been. I think people aren't using history to understand where we are now. And if you look at UMich surveys, both 1-year and 5-year inflation expectations are below the long-term average. So consumers and businesses in their perception don't think there's inflation. CPI is elevated, but as you guys know and talked about, and many economists point out, it's really due to two components that are kind of lagging, right? One's shelter and one is auto insurance. And the median CPI inflation rate right now is 1.4% year over year. Its long-term average is 1.6. Everything except for housing and auto insurance is below trend.
Median is when you just look at what each component is doing, and some are higher and some are lower, but the median category is
there's
137
components. Another way to look at it is what percentage of the basket of CPI equal weight is below their long-term year-over-year growth rate. So take each component and just say, where does it sit? It's now at 55%. So and the long-term average is 50. So more than 55% of CPI components are below their long-term average. It's considered controlled when it's 50%.
We're at 54.73. Tracy mentioned your June target. Do you have a year-end target for the market or a 1-year target or anything like that right now? Like, where can we go?
Well, on the first week of December 2023, we had said our target for 2024 was 5,200, which at the time was almost 20% upside. Now our 5,200 is low because we're above that level.
Yeah.
We haven't changed our target because our practice is typically to do it at the mid-year.
Okay.
So we're 2 weeks away.
Can you give us a little hint?
Yeah, I'd say originally we said earnings could be 270.
Okay.
And we'd put like an 18 multiple on that. and that's got you to 5,200. 2025 earnings it no longer look like 270. It looks more like 285.
Okay.
And as I was citing, as interest rates moved up, the PE should be higher. So let's say 20 is a more appropriate PE multiple, or even 21. Then you get into the 5,800-ish level. But I think the open question is really, if you're in mid-June and December 31, is it a line up, or is there a pullback and then a line up? And I would probably, this is not evidence-based, just an opinion. I don't see why it would be straight up.
Here's something I always wanted to ask an equity strategist, but when you're coming up with the price targets, do the specific numbers actually matter for your clients, or are they mostly interested in the direction, the overall direction, like line go up, line go down?
Well, it's do you know, this is a lifelong debate, because for 30 years I covered wireless stocks and had price targets, and our salespeople would always say, "No one cares about your price target." But then, first thing in the meeting, people are like, "What do you think? Where do you think this thing goes?" So they always care about the price target. I don't really value people's price targets, which is 10% above where you are now, because to me, that's like staying in the middle of the lane, and you can't make clients money. So whenever we did stock research, we always had to build a base case on what we think could happen and then discount it at what we think is a reasonable rate. A lot of our price targets seemed really crazy when we did wireless. I remember I upgraded, you can timestamp it, I actually show you, Alamosa Holdings at 21 cents and it went to $22. My price target was not 30 cents, it was $12 at the time. And we upgraded Western Wireless at $1.74. Our price target was $25 and it ended up going to 40. So I think we try to look at a normalized situation, and in a normalized world, if this is a normal S&P cycle, okay, following demographics, I could provide a chart later. S&P should be potentially 15,000 by the end of the decade.
I'll take it.
Yeah, so to me, that's the more, as you move into longer time frames, that's probably where I think we're moving towards.
Can we title this episode, Tom Lee, why S&P could go to 15,000 by 2030? Is that cool?
Sure.
Okay.
We have many charts to explain that number.
Oh, you should send them to us, and
Yeah, we'll
include
post some
them.
of them. Yeah, that'd be great.